Hi, I'm Benjamin Bach, and you're watching another real estate investment update. What I'd like to talk to you about today is some basic terms we use when we're out looking at investment properties. And if you understand these terms, you're going to be more knowledgeable when you're out talking to investors, whether you're looking to buy or sell property. And also, if you're a realtor watching this video, you're going to understand what investors are talking about when they use some of these terms with you. The first term is your gross rental income. Now what your gross rental income is that's all the rental income that a property generates. And that's going to include the amount people pay you for the rooms, which is typically what people think about when they think about rent. But it's also going to include any laundry income, any parking income, if any of the tenants are renting storage from you, or any other additional fees that the property generates in terms of rental income. Net operating income is what you have when you subtract vacancy and operating expenses from your gross rental income. So you'll take your gross rent and you'll subtract the vacancy allowance and any bad debt allowance, as well as your operating expenses. And operating expenses are any expenses you incur in the operation of the property. So this will include paying your property taxes, your insurance, any utilities, hydro, gas, water, that the house or the owner incurs, any winter maintenance, lawn maintenance, snow removal, garbage removal, paying people to rent out the units, maybe paying a superintendent if it's a larger building. So that's how you arrive at your net operating income. We subtract vacancy and operating expenses from the gross rental income. A pro forma financial statement is usually something that you'll see associated with the marketing of a listed investment property. And what a pro forma income statement usually is it's usually a financial statement based upon a set of projections. So you might have projected rents or projected capacity. So say a property is vacant. A realtor who's marketing the property or the owner might put together a pro forma statement showing what the new owner could expect to generate based on current market rates and market occupancy. Pro forma statements should also include vacancy rates, management fees, maintenance fees, repair allowances, and these will typically be based on industry standards. Cash on cash return is a similar calculation to a cap rate, but what we find is that it's a lot more useful to an investor. So a cap rate, what it tells you is the relationship between the income and the price. What the cash on cash return tells you is the relationship between your net cash flow and the cash you invested to buy the property. So if we look at $1 million property, it's rare that somebody buys that all in cash. So you're rarely investing $1 million to buy a place for $1 million. You might invest a 30 or 40% down payment and the bank will come up with the rest. So the cash on cash return looks at the profit on your 30 or 40% investment or whatever your down payment is. So it shows you what your equity invested is generating. And that's a lot more applicable to an investor. Because if you have $200,000 to invest, you don't really, the biggest concern there isn't what the property generates, it's what sort of return will you get on your $200,000 that you need to invest. So you might look at the cash on cash return at a building for $400,000 and a building for $800,000. And you don't care what the cap rates are, you care what sort of return you're going to get on your equity that you're investing. When you hear an investor talk about the principal paid down on their property, what they're discussing is the amount that they're paying off of their loan balance every month or every year. So say you own an apartment building and you have a $2 million loan outstanding on that property. Now if you're paying off $30,000 a year off that loan, that's $30,000 less money that you owe the bank, and that's money that's in your property in equity. So the principal reduction or the debt reduction is a reduction in the amount that you owe the financial institution that lent you money to buy the property. When you reduce the debt completely, you don't have any mortgage or any debt secured on it. You'd own that property free and clear. And if you hear somebody say a property is free and clear, what it means is it's free and clear of mortgage encumbrances, so there's no mortgage associated with that property. If you've heard some commercial real estate terms that you are unsure of, send me an email. You can reach me at benjamin@benjaminbach.com. You can find me on Twitter at benjaminbach or at our website benjaminbach.com, or you can call me at our office at 519-570-4447. I'd love to help educate you about some investment and commercial real estate terms, and I'd love to talk to you about buying or selling real estate in the Waterloo region.